Welcome back to the Daily Crypto Roundup, the show that keeps you ahead of the market every single day. If you're getting value from the podcast, hit follow and, if you can, leave a 5-star rating. It really helps push the show higher in the rankings, helps the algorithm find new listeners, and keeps this community growing. Let's jump straight into what's happening. Across the market today, the screens are mostly red. Bitcoin sits just below 120,000, off roughly 3%. Ethereum is trading around $4,280, down about 4% on the day. Solana is hovering near 217, also down around 3%. XRP has slipped to $2.79, a decline of about 2.5%. Cardano sits at 80 cents, off 3%. Avalanche trades near $28, down about 3%. Dogecoin sits at 24 cents, down roughly 5%. Tron is holding firm around 33 cents, off just under 1%. Chainlink trades near 21.5, down around 1%, while Litecoin, the only bright spot today, is hovering just above $118, up about 1.5%. So why is the market pulling back when just days ago we were printing new local highs? The short answer: macro headwinds and cooling ETF flows. The U.S. bond market spooked investors again this morning. Yields on the 10-year note climbed higher after another stickier-than-expected inflation print, and that instantly strengthened the U.S. dollar. Whenever yields climb and the dollar firms, risk assets like crypto and equities tend to take a step back. It's not about crypto losing faith. It's about big money rotating temporarily towards safety. It's a mechanical rebalancing, not a meltdown. The second factor is that the torrent of ETF inflows has slowed slightly this week. Last week saw almost $6 billion in new institutional money flow into Bitcoin and Ethereum ETFs, one of the biggest bursts of demand we've seen since midsummer. This week, it's quieted down to roughly $1 billion so far. That's still solid, but it's less of a tailwind. So naturally, without that constant institutional bid, the market drifts lower. It's a breather, not a reversal. And finally, traders are doing what they always do ahead of big macro data: trimming risk. With new US CPI numbers due, job reports coming, and earnings season in full swing, no one wants to be overexposed in volatile assets before those data prints hit. Add a sprinkle of nervous commentary from some of the traditional finance world, like Hargreaves Lansdown warning clients that crypto has no intrinsic value, and you have a recipe for a market that's taking a breather. But let's put this in perspective. This is a completely normal part of a maturing cycle. The fundamentals have not changed. Bitcoin's supply is still fixed. Ethereum's burn rate remains deflationary in many blocks. Solana continues to see more than 1 million daily active wallets. XRP's network upgrades are still on schedule. Cardano's governance improvements are moving forward. Nothing structural has broken. The market is simply adjusting to external noise, inflation data, interest rates, and the flow of capital, just like any other large asset class. Now, one of the biggest institutional stories today comes from Fidelity. The asset management giant has just announced a fee cut on its Bitcoin ETF from 0.35% to 0.25%. That might sound small, but it's a shot fired in a growing price war among traditional finance firms offering crypto exposure. When major players like Fidelity start undercutting each other on fees, it shows they're serious about competing for long-term investors. It means crypto is not being treated as a speculative niche anymore. It's being treated as an established investment category. Analyst David Crone from Morningstar called the move a pivotal moment that signals ETF competition is reaching the same scale as traditional index funds. In other words, the same way low-cost index investing reshaped the stock market 20 years ago, low-cost Bitcoin ETFs are now reshaping crypto access for institutions and retail alike. And he's right. In the US, Bitcoin ETFs are now seeing consistent net inflows week after week. In the UK, it's behind the curve, but the Financial Conduct Authority's decision to allow crypto ETNs again earlier this year is slowly bridging that gap. Still, Hargreaves Lansdown, one of Britain's biggest retail brokers, is holding the line with a conservative tone. In a statement this week, they reminded clients that crypto does not produce income or have intrinsic value and urged caution. That kind of language shows you where we are in the adoption curve. Across the Atlantic, Fidelity and BlackRock are fighting for market share. In London, traditional brokers are still trying to decide whether crypto should even be part of the portfolio conversation. The gap between these two approaches is closing, but slowly. Let's switch gears to XRP, because it's been trending again all week. The $4 target chatter is back. A combination of on-chain analysis and technical momentum is behind it. Glassnode data shows a rise in active XRP wallet addresses, while Sentiment reported that whale wallets holding over 1 million tokens have increased by about 6% over the past fortnight. Analysts like Ben Armstrong and Kevin Cage have suggested XRP is building energy beneath the surface. The key technical level is around $3.10 to $3.25. If XRP can break and hold above that zone, $4 is the next major resistance. Of course, this is XRP, and it's never smooth sailing. If momentum fades, a pullback to 280 is still possible before another breakout attempt. But the reason so many holders are patient is simple. The underlying thesis hasn't changed. Ripple's technology is still aimed at real-world cross-border settlement. The company continues to secure partnerships with payment providers, particularly in Asia and the Middle East. And that means there's still a fundamental use case behind the price speculation. Now, while XRP's story plays out technically, another bigger narrative is unfolding across global markets, what some analysts are calling the Debasement Trade. With inflation staying sticky and global debt piling up, investors are once again rotating into assets that can't be printed or inflated away. That's why gold has quietly rallied again. That's why Bitcoin's institutional adoption curve is steepening. And that's why more investors are adding small allocations to Ethereum and Solana as part of their inflation hedge basket. In a world where every government is effectively borrowing from the future, scarce digital assets become the insurance policy. Economist Alex Kruger summed it up nicely this morning. He said, "This is not a crash, it's the market breathing. The debasement trade is alive. Bitcoin is doing exactly what it's supposed to do: absorb volatility and position itself as the hedge against policy failure." And that's exactly what's happening. When traditional investors talk about debasement, they're talking about dilution of fiat value. Crypto is the counterbalance. Volatile, yes, but scarce and programmable. Now let's tie in the S&P 500 story, because this is key for understanding why today looks like synchronized weakness. The index has dipped back below the 5,000 mark after 2 consecutive sessions of selling. It's the same yield and inflation dynamic, not crypto-specific. Tech stocks have pulled back, risk assets have pulled back, and crypto, being the farthest out on the risk curve, amplifies the move. This correlation is actually a sign of maturity. It means crypto is finally behaving like a legitimate macro asset, moving with global capital flows rather than in isolation. Meanwhile, one of the more unexpected stories today came from India's finance ministry. Finance Minister Nirmala Sitharaman said that crypto regulation must be consistent, coordinated, and credible on a global scale, adding that India's stance remains cautious but cooperative. For months, India has been one of the most uncertain major markets for digital assets, but comments like this show a potential softening. That matters, because India's population and remittance network make it one of the largest untapped on-ramps in the world. Underneath all of this noise, Bitcoin's fundamentals are stronger than ever. Mining difficulty remains near all-time highs, signaling confidence from miners. ETFs continue to hold net positive flows over a 30-day period. And long-term holder supply, the amount of Bitcoin that hasn't moved in over a year, is near record levels. That's what underpins the structure of this market. When short-term traders panic, long-term holders accumulate. When institutions pause inflows, miners keep validating. It's the same quiet rhythm every cycle. Before we wrap up, a quick word on security. And this isn't sponsored fluff. If you haven't already secured your holdings, now's the time. Every time we see market turbulence, we see more hacks, more scams, and more people losing access to their assets because they left them on exchanges. Get a Ledger hardware wallet. It's the simplest, safest way to store your crypto offline. You'll find the affiliate link in the description. It supports the show, but more importantly, it supports your own security. To close, here's what to watch heading into tomorrow. Bitcoin's 118 to 120,000 support range remains key. Ethereum's next bounce zone is around 4,200 to 4,400. XRP needs a strong close above 325 for that $4 talk to stay alive. Solana's 215 range is key for keeping its structure. Watch ETF flow data tomorrow. If we see even a small pickup, this dip could reverse by the weekend. So take a breath. The market's not broken. It's just doing what markets do: consolidating, resetting leverage, and preparing for the next move. If you've been through a few cycles, you already know this part. These dips shake out the noise and set up the next wave. That's your daily crypto roundup. Remember to follow the show, and if you enjoy these daily breakdowns, drop a 5-star rating. It really helps get this podcast in front of more listeners. We'll be back tomorrow with fresh data, new stories, and the latest from the market. And as always, we'll see you at the top.